Last week, in an interview with CNBC, Ray Dalio, the billionaire investor and founder of Bridgewater Associates, said, quote, "We're certainly in a stagflationary period." Is Dalio's understanding of current economic conditions accurate? If so, what does that mean for your investments? Hi, I'm Brian. I'm an investment advisor. I manage portfolios for investors like you. Let's talk market forces. Last week, U.S. stocks were up. Both the S&P 500 and the Nasdaq added about 1% for the week. Commodities and Bitcoin also moved higher. Bonds and gold were down. Today, I want to discuss three market forces. The Fed left interest rates unchanged, but Chairman Powell said the quiet part out loud. The U.S. economy is now in stagflation. Warren Buffett says, "We've never had more investors in a gambling mood than right now." The Fed leaves interest rates unchanged, but Chairman Powell said the quiet part out loud. Last Wednesday, the Federal Reserve announced that the federal funds rate would remain unchanged at 3.5 to 3.75%. The Fed funds rate is the interest rate that banks charge each other for overnight loans. The Fed has held this rate steady for 3 meetings so far this year after making 3 successive cuts to the bank lending rate to close out last year. The official statement from Chairman Powell left the door open for rate cuts later this year, but there were 2 hints that I think show the Fed is unlikely to cut rates in 2026. The first hint was 3 dissenting opinions from FOMC members which were opposed to the inclusion of language showing a bias towards easing interest rates. There were 4 dissents in all, and that means that was the highest number of dissents for any FOMC meeting since I was in high school. That's back to 1992. The second hint came at the press conference after Powell's prepared remarks. In his answer to a question from a reporter, Powell admitted that tariffs are having a more significant impact on inflation than the Fed and others expected. And then he said the quiet part out loud, quote, "I think we'd want to see the backside of that and progress on tariffs before we even thought about reducing interest rates." The Fed's official statement was crafted to give markets hope of a rate cut later this year, but I think the dissents and Powell's acknowledgement of continued tariff pressures revealed the Fed's true position. They're closer to raising rates than cutting them. The U.S. economy is now in stagflation. In an interview with Becky Quick on CNBC, Ray Dalio said last week that the U.S. economy has slipped into stagflation. Interestingly, Dalio also said that cutting the Fed funds rate would be a mistake and, in fact, would damage the central bank's credibility. The term stagflation was popularized in the 1970s to describe economic conditions that combine stagnation and inflation. In other words, slow or contracting economic growth accompanied by rising prices of goods and services. And there's plenty of evidence for both today. We're all too aware of rising prices throughout the economy. Inflation is running at an annual rate of 3.3% and has been trending above the Fed's 2% target for over 60 months, all the way back to March of 2021. The war in Iran has shattered stability in the energy markets. Food prices are being driven higher by rising fertilizer and transportation costs. Stress across a number of supply chains is driving prices of many goods higher, and the full effect won't be felt for another month or 2. The energy shock is going to linger longer than most people expect. I believe inflation will hit 4% in the coming months and remain high throughout year's end. There's no question we've got deflation, but there's some debate about the stag. But I think when you look past the headline numbers, it becomes clear. According to Rosenberg Research, excluding healthcare and education, 82% of the labor market is in contraction, meaning employment growth is actually negative. Outside of financial services, healthcare, and the tech capex boom, broader GDP has experienced back-to-back negative readings, indicating that three-quarters of the economy is already in recession. Real disposable income is flat, and consumers are heavily relying on credit and drawing down savings. The Atlanta Fed GDP Now model has first quarter GDP tracking at an annual rate of just 1.2%. The University of Michigan Consumer Sentiment Index is sitting at 49.8, a level lower than the depths of the Great Financial Crisis and the COVID pandemic. We won't get final revised economic data on the first half of 2026 until around year end, but I agree with Dalio. The data will show we're in a stagflationary environment now. Warren Buffett says we've never had more investors in a gambling mood than right now. Berkshire Hathaway hosted its 2026 annual shareholders meeting over the weekend in Omaha, Nebraska. The meeting marked a significant transition with Greg Abel as CEO taking over for the first time. During the lunch break, Warren Buffett was interviewed on CNBC and compared the stock market to a church with a casino attached, saying enthusiasm for gambling has reached a peak. We've never had more people in a gambling mood than right now, Buffett said. His comment got my attention because 2 weeks ago, I recorded a video called A Gambling Mood on Wall Street. Mr. Buffett, thanks for watching my videos and reading my market commentary. It's much appreciated. Today's S&P 500 CAPE ratio, a measure of stock market valuation, is higher than 99% of all historical valuations. It's driven by investors' overconfidence and FOMO, or fear of missing out. When stock market prices reach these extreme levels, the primary concern is not necessarily an immediate crash, but rather the mathematical reality of what your investments are likely to earn over the next decade. Historically, when valuations are this high, returns over the following 10 years are very low, sometimes even negative. This means that if you're relying on a traditional buy and hold strategy, your portfolio might be priced for a lost decade of little or no growth. Recognizing current market conditions is the first step to protecting your wealth. To navigate this environment, your portfolio should be focused on risk management and diversification beyond U.S. large-cap stocks. At Alpha Rock, we favor asset classes like energy, infrastructure, physical assets, and companies that have the pricing power to weather economic shifts. If you'd like to see how I'm investing for my clients, download my second quarter investment outlook, The End of Easy Money. It's free at alpharockinvestments.com. Before you go, click like and subscribe. It helps me reach new viewers. And to learn more about our services, contact me directly or subscribe to my weekly market commentary. Links are in the description.